Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we don't run from weakness. We run towards it, tools in hand, ready to stress test the damage. And today, we've got a live one. We are putting Lindsay Corporation directly under the microscope. The stock is taking a nosedive this morning after dropping an earnings report that, if you just read the headlines, looks like a complete and total structural failure. A structural failure, that's putting it mildly. The market is absolutely spooked, and you know what? I don't blame them for a second. The numbers they just released look less like a quarterly report and more like an accident scene. It feels like a demolition crew took a wrecking ball straight to their income statement. This isn't just a garden variety sell-off we're seeing, it feels more like a full-scale evacuation. Well, panic is a powerful force, but it's almost never a precise one. The market has a nasty habit of overreacting, selling first, and asking the important questions way later. And that's our sweet spot. That's exactly where we come in. Our job today is to get out the original blueprints, run a full suite of diagnostics, and determine if this building's foundation is actually cracked, or if this market panic is just creating a prime opportunity to buy a solid asset at a steep discount. So let's get to work. Okay, let's start with the immediate damage assessment. This was the very first number that traders and algorithms saw flicker across their screens this morning. The stock, LNN, down over 3.5% in pre-market trading alone. That's an immediate, gut punch reaction to the press release, all happening before the opening bell even had a chance to ring. Right, and you absolutely have to ask why. A drop like that doesn't just happen in a vacuum. It's a blaring siren, a clear signal of raw fear. It's the result of countless algorithms and real-life investors all hitting the sell button without a moment's hesitation. So what was the trigger? It all started with that headline earnings number. This wasn't some small misstep. It was like watching someone confidently walk right off a cliff they didn't see coming. Precisely. The headline miss was absolutely severe. Earnings per share, the bottom line, came in at $1.15. Now, the consensus estimate, the number that all the analysts who cover this company for a living had agreed upon, was $1.70. Let me be clear, that is not a rounding error. That is a massive, jaw-dropping 27.9% miss. They fell short of Wall Street's most basic expectation by nearly a third. This isn't just a minor crack in the wall. The entire public-facing facade just crumbled into dust. When the so-called experts get it this wrong, it tells you that something fundamental, something deep under the surface, shifted dramatically, and absolutely nobody saw it coming. This is the kind of report that forces investors to question the entire thesis, the very story they built around this company. We will see about that. Today, we're not just going to stare at the cracks in the paint. We are running a full structural analysis, from the foundation to the roof. We're going to find out if the entire building is truly compromised or if it's just the drywall that's taken a hit from what might just be a temporary storm. So here's our blueprint for today's deep dive. We're going to start with what we're calling the top-line demolition. That's a look at the consolidated numbers that sparked this whole panic. Then, we're going to drill down segment by segment into their two core businesses, irrigation and infrastructure. We need to find the real source of the weakness. After that, we inspect the most critical part of any company that's under this kind of pressure, the balance sheet bedrock. This tells us if the foundation is actually solid. And finally, we'll pull it all back together and deliver our final blueprint on the situation. Let's get into it. Okay, time to get the ugly numbers out on the table. No sugarcoating it, no spin. This is the consolidated report card for Lindsay's second quarter. Brace yourself because it's not pretty. The damage here is undeniable and it's completely across the board. Total revenues are down a significant 16%, falling from $187 million a year ago to just $157 million today. But here's where the story gets really ugly. The number that truly defines this quarter is profitability. Operating income is down a staggering 59%. Net earnings? Down 55%, and the bottom line for shareholders, earnings per share, was cut by more than half. Look, a 16% revenue drop is a problem for sure. But a 59% drop in operating income isn't just a 5-alarm fire, it's a full-blown inferno. This means the company's economic engine isn't just sputtering a little, it's on the verge of seizing up. For every single dollar of sales they lost, their profits fell by an exponentially larger amount. It's a sign that they're becoming dramatically less efficient at the one thing they're supposed to do: make money. And this gets to the absolute core of it. We have to talk about operating margin. For those of you at home, this number tells you how much profit a company makes from its core business operations before you even factor in things like interest and taxes. Last year, Lindsay kept 17.2 cents of profit for every dollar of sales. Pretty healthy.
This quarter, a meager 8.3 cents. Their ability to generate profit from what they sell has been utterly decimated. This points to a very serious structural issue. It could be a loss of pricing power, runway costs, or even worse, a combination of both. This is the number that has the market truly terrified, and honestly, it should. All right, so we've confirmed an inferno in the consolidated numbers. Now let's act like fire investigators. It's time to break this whole thing down segment by segment to find the source of the blaze. We're going to start with their biggest revenue driver, their historical core, the irrigation business. So overall irrigation revenue is down about 5%. Now, that's definitely better than the consolidated 16% drop, but the real devil is hiding in the details. Their core domestic market, North America, is down a very concerning 8%. The company is crystal clear about why. Commodity prices are weak, which means farmer sentiment is in the gutter. When crop prices are low, farmers don't feel confident enough to invest in big-ticket equipment. This is their bread and butter, their home turf, and it's showing significant weakness. You simply cannot ignore a downturn in your primary market. That's true, and the U.S. market being soft is a major headwind, no doubt about it. But what's really fascinating here is the other side of the coin, the international business. It is, for all intents and purposes, holding up the entire segment on its back. International revenue is down only 1%. In this environment, that is essentially flat. It's acting as a massive stabilizer, preventing the domestic weakness from completely sinking the ship. And we need to dig into why it's so stable, because it's not by accident. It's being driven by one single gigantic project. They have officially started deliveries on a massive $80 million multi-year deal in the Middle East and North Africa region. Now, this isn't just any old project. It's a foundational contract that is going to provide a steady, predictable stream of revenue for quarters to come. If you strip out some of the temporary issues they're having in Brazil, you can see that this one deal is literally backstopping the entire segment. A lifeline is more like it. One big project isn't a long-term strategy. It's propping up a segment that is otherwise showing significant decay in its most mature, most important market. So what happens next year when that MENA project is further along in its delivery schedule? Is there another $80 million deal just waiting in the wings to take its place? I doubt it. Relying on these massive, lumpy projects just creates a ton of volatility. Sure, it might be saving them this quarter, but it makes the future incredibly uncertain. To me, that doesn't look like strength. It looks like a whole lot of risk.
Okay, so the irrigation segment is a real mixed bag. You've got a weakening core being propped up by a single, massive project. But what about the infrastructure segment? Well, this is where the story gets really, really interesting. And this is where the headline numbers are, frankly, profoundly misleading.
Misleading? How can you call this misleading? We are looking at a 58% collapse in revenue. It went from nearly $39 million last year all the way down to just $16.5 million this quarter. And the operating income? Get this, it fell an astonishing 91%. If irrigation had a fire, this part of the building has experienced a complete and total system failure. A 91% drop in profitability is a wipeout. There's no other word for it. How is that misleading? It's misleading because before we condemn the entire segment, we have to understand what caused the collapse. And it all comes down to one specific product, their road zipper system. You have to understand, these are massive, complex, high-value infrastructure projects that are, by their very nature, lumpy. They don't happen every quarter. And last year, in this exact same quarter, they didn't just have a project, they delivered a monster, a massive, one-time $20 million road zipper project. Now here's the kicker. The company explicitly stated in last year's press release that this specific project was not expected to repeat. This is the key piece of the puzzle that the market's knee-jerk, panicked reaction completely, totally missed. And this right here, this brilliantly illustrates the core issue. That $20 million project from last year created what we in the business call a tough comp, an incredibly difficult, almost impossible comparison to beat. It's what makes the year-over-year numbers look like an absolute catastrophe. That single project from last year accounts for almost the entire revenue shortfall you see in the segment this year. Exactly. And when you normalize for that one-time anomaly, the entire story completely flips on its head. If you surgically remove that one-off project from last year's results to get a true apples-to-apples comparison, the rest of the infrastructure business, their core bread-and-butter road safety products, that business actually grew by 6%. So underneath all the noise of that massive non-recurring project, the underlying business is actually healthy and expanding. That's a very clever way to reframe a 91% collapse in profitability, I'll give you that. But it doesn't change the simple fact that their big-ticket item vanished and left a gaping hole in their financials. It actually highlights the inherent lumpiness and the risk of this business model. Sure, the smaller stuff grew a bit, but the big moneymaker disappeared completely. That's not a one-time anomaly. That's a structural flaw. It proves the segment is volatile and fundamentally unpredictable. Okay, so we've established the earnings took a major hit, mostly from a tough one-time comparison, and their core domestic market is definitely soft. In a storm like this, a company's real strength isn't its income statement, it's its foundation. We have to look past the volatile P&L and inspect the balance sheet. This is what tells us if they can truly withstand this kind of pressure. First things first, cash is king. And they are sitting on an absolute war chest of cash and cash equivalents. We're talking over $186 million. In a tough economic environment where sales are down and credit might be tight for their customers, having this much cash on hand provides a tremendous amount of flexibility. It's a buffer, it's dry powder, it's security. All right, next, let's look at their debt load, because cash doesn't mean much if you're drowning in debt. But they're not. Their leverage is incredibly low. Their gross debt to EBITDA ratio is just over 1. This is a critical sign of financial strength. It means they have very little debt relative to their earnings power. They are not beholden to creditors. They control their own destiny, which is exactly what you want to see when their end markets are facing serious headwinds. Now, let's look at a forward-looking number, one the market might be completely ignoring in its panic. Their backlog of unfulfilled orders is growing. It's up to over $151 million, a nice jump from $127 million this time last year. And that growth is largely thanks to that big MENA irrigation project we talked about. This isn't revenue they hope to get. This is a bridge of predictable contracted sales that will carry them through the coming quarters. And finally, the ultimate question. What is management doing with all that cash? Are they hoarding it? No. They are buying back their own stock, and they're doing it aggressively. They've already spent over $55 million on repurchases just this fiscal year. This is a classic, powerful signal from the people who know the company best, the management team, that they believe their stock is fundamentally undervalued by the market right now. I have to ask the question, though. I have to play devil's advocate here. With headline numbers this bad, is spending $55 million of precious cash on buybacks really the most prudent use of that capital? Or are they just trying to signal a strength that they don't actually have? A true skeptic would argue they are desperately trying to put a floor under a falling stock price rather than investing that cash in R&D or maybe a strategic acquisition to actually reignite some real growth. It's a valid question any serious investor should be asking themselves. All right, the inspection is complete. We've stress tested the structure, we've seen the surface damage, and let's be honest, it is significant. But we've also inspected the foundation, and it looks surprisingly solid. So now it's time to draw up the final report and decide if this is an opportunity to build a new position or a dangerous trap to avoid at all costs. From my perspective, the bearish case is crystal clear, and it's compelling. You simply cannot ignore the headline numbers. Massive year-over-year drops in revenue and a nearly 60% collapse in operating income. Their operating margin was literally cut in half, which signals extreme profitability pressure. Their main U.S. market for their core irrigation business is undeniably soft. The infrastructure segment is now proven to be dangerously volatile, and Brazil continues to be a persistent weak spot. The cracks we see are not just on the surface, they appear to run deep. But the bullish case, the strong case, argues that you have to do the heavy lifting that the rest of the market simply won't. You have to look past the headline noise. The infrastructure weakness is largely an illusion, caused by a tough comparison to a one-time mega project. Underneath that, the underlying business is actually growing. A huge international contract is backstopping the irrigation revenue, and that growing backlog provides visibility into the future. But most importantly, the balance sheet is a fortress. We're talking high cash and very low debt. This company is built to withstand this kind of pressure. And that buyback, it's not desperation. It's a confident declaration from management that they believe the market is dead wrong. So here's the crucial point, the bottom line. The market saw the surface cracks. It saw that ugly earnings miss and the sharp revenue decline, and it fled for the exits. But our deep inspection reveals a much more complex picture. Yes, there is clear damage, especially to their profitability and in their core U.S. market. But there is also a surprisingly strong foundation, with a rock-solid balance sheet and a backlog that provides a significant buffer against the storm. So, the final question is for you. Is this a generational buying opportunity created by short-term panic, or is it a classic value trap? That's your call to make. But one thing is for sure, the market has reacted to the headline, not to the footnotes. And for the disciplined investor who's willing to do the work, there could be a real opportunity here. At Iron Financial, we give you the tools. You make the call.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.